Namaste and welcome to another edition of the Bharatvaarta Weekly. I'm Roshan Karyappa. I'm joined by Abhishek Paul and Neerav Kanodra to run you through the news and events of the week that was. And this week we had some chaotic news. Silicon Valley Bank became the largest bank in the US since 2008 to fail. The Indian and Australian Prime Ministers met in India to discuss strategic ties. India and US signed a pact on semiconductors, and that is very, very significant, as we will discuss. And in some very interesting geopolitical news, China has brokered a deal between Saudi and Iran. Well, it's another bright and sunny Sunday morning, and we have a good day of Test cricket lined up today. Neerav, excited for the match?
Yeah, the match is going on as a little bit slow and might end up in a dull draw. And we retain the series probably 2-1. But yeah, it's bright and sunny here. Smog is actually lifted off in the last couple of days with the higher temperatures. So that's a good thing.
Abhishek, Bangalore is baking right now, yeah?
Relatively speaking, yeah.
Yeah. So last week we put out this episode on FinTech 2.0, finally long awaited, and it has had a very good response. A lot of you have been writing to us about the various aspects that we've discussed, and some of the things that we've left out. But obviously, we couldn't cover everything about everything. We will probably do a 3.0 maybe sometime in the future, and we can talk about a few of these other things as well. If you haven't already checked it out, do check it out. If you are a new visitor, we publish episodes on politics, policy, and culture every week. Do follow and subscribe to us if you're interested in that kind of content. We've been doing this for about 3+ years now. If you are a returning visitor, please don't forget to rate and review us on your favorite platform. It'll really help more people discover our content. All right, let's get started with the first major news for the week. Startup-focused Silicon Valley Bank became the largest US bank to fail since the 2008 financial crisis on Friday. The collapse was caused due to a sudden bank run by depositors in a panic triggered by several factors, which include failure to raise funds, selling bonds at a loss, etc. California banking regulators closed the bank and appointed the Federal Deposit Insurance Corporation, or the FDIC, as receiver for later disposition of its assets. Well, this has been really chaotic news in the startup world for the last couple of days or more. Any Indian startup which has to flip its registration and incorporation post a fundraise, right, chooses Silicon Valley Bank because they have very, very startup-friendly terms, and they're also an iconic Silicon Valley institution, right? I mean, they've been around for like 40-50 years now and are reasonably big as well, right? I mean, they're perhaps the top 20 largest banking institution in the US. They had something like close to $190 billion in assets. And it's pretty unfortunate what has happened. I've been in touch with founders and operators over the last couple of days, and literally everyone is scrambling, right? They're not able to get their money out, and a few of them might unfortunately not make payroll as well, right? So the situation is pretty tense, and it's such a surreal time where you can't even take your bank deposit for granted, right? I mean, it's a really crazy time. I'll talk a little bit about what triggered the crisis, and maybe Neerav can kind of fill in all of the technical gaps. As I understand, the bank deposits ballooned between 2019 to 2022. It went up from somewhere around $60 billion to something like $180 or $190 billion. And the bank decided to invest in a lot of these mortgage-backed securities, or the US bonds as they call them, which were at a 1.5% guaranteed 10-year interest at that point of time. As all of you would have noticed, the Fed has been increasing rates over the last 2 or 3 quarters steadily, and the value of these MBSs have really gone up, right, relative to what the bank had purchased it at. And if I understand correctly, there was a liquidity crisis and not so much a solvency crisis, right? So which is that the deposits had dried up over the last year or so, obviously because the funding has dried up as well, and the interest rates are back up. And the bank decided to sell some of these MBSs at a loss, right? They decided to sell them at a $1.8 billion loss, really to have enough liquidity on hand in case of any withdrawals and so on. Now, you can call it a bit of a PR fiasco, or the fact that, maybe some people were extra sensitive to this. Folks like, Peter Thiel of the Founders Fund, the Union Square Ventures and so on, kind of picked up on this fact that, the bank actually sold it at a loss, and really advised all of their, their own portfolio of startups and others in the know to kind of withdraw deposits, right? I mean, Peter Thiel himself has withdrawn all of his money from the bank since, right? And this kind of triggered a bank run with, a lot of folks really, withdrawing their deposits as such. And the bank was not able to make that whole. and which is why FDIC had to step in, and the bank is, for all good and effective reasons, it is shut now. I think the stock price has dropped 60 or 70% since the time Jim Cramer perhaps recommended it. So it is a bit of a unfortunate situation. The FDIC says that up to 250K is withdrawable at this point of time. For anything more, I think they will have to sell the assets of the bank and then perhaps make good for the depositors. It's really a troubling time. Nirav, could you just help fill in the gaps?
Sure. So see, if you look at it, I think, banks take two type of risk. So one is credit risk, that they give you what we consider, deposits are kind of considered risk free. So they take a lot of deposits and they lend it out to whatever riskier lending. And with a law of large numbers, that default should be less than the net interest margin. So that is one part, right? That they take credit risk. Second is they take duration risk, right? Or interest rate risk, that they borrow short term, because your checking account, you can take out your money anytime, but usually they are sticky and not everybody takes out their money at the same time, and they lend long. And even if you effectively is say I am lending a 30-year US mortgage at like a fixed rate, it is amortizing over 30 years. So on an average, I get my principal paid back in year 15. But I borrow every day overnight via my depositors, or say I could repo these securities and like borrow in the money markets from other banks who have excess liquidity. So basically, it is lending long and borrowing short, right? So that is the interest rate risk part. After the financial crisis, etc., there's a lot of focus. All the stress tests of the banks, everything has been on the credit risk side of it, right? That what if customers default? You need better KYC norms, better, you need to check at loan to value ratios, etc., etc., etc. What people have kind of ignored, that for 15 years you had like near zero interest rates, and then suddenly you raise them by 5% in a year. There's a big interest rate shock, and this has not happened since 1980. Right. So if like next week the Federal Reserve raises by 50 basis points instead of 25, that will be actually higher in a 12-month period. It's the highest ever, right? Going back to like 1940s, etc. Right? So people did not either take into account this risk. And then second thing, so let's take a very simple example. Let's take a bank with an asset size of 100 rupees or $100. I'm taking very rough numbers, but 10% is equity. This is shareholders' equity, right? 10% is usually market borrowings. And I'm talking about a small bank, not a complicated, what they call as global systemically important bank. That is like JP Morgan or Goldman Sachs, etc. Those GSIBs are way more complicated. I'm taking like a very simple bank compared to like an Indian retail bank as well. So you say, okay, 10 is from shareholders, 10 maybe from bondholders, and 80 rupees is on your liability side, is your depositors. So maybe you have 80 different depositors of deposits of 1 rupee each, right? So that is one. On the asset side, you have to have some sort of a liquidity coverage ratio, that you have to have some liquid securities which you can sell immediately in case of withdrawals, right? So you have some government bonds or some mortgage-backed securities in the US. This is very specific to US, that these securities are quite liquid. You can trade them around, etc., because you have a pool of mortgages that is clubbed into one security. So these assets, and then you have some corporate loans, you have some personal loans, auto loans, etc., right? And trade credit, whatever. So you have like, you are lending out, and ideally you have to have something as like a cash deposit with the central bank. So in India's case, I can say very comfortably. So in India, cash reserve ratio is about 4%. So if you have a balance sheet of 100, 4 rupees you have to deposit with RBI. Then you have about 20% is statutory liquidity ratio, which is you need to invest in government securities or state government securities. So that is another 20. And the 76, you try and give out loans, and maybe you try not to have too much concentration on your loans, so that no one person can have more than 5 or 10%. You have like a large exposure framework. So you have like, maybe assume you have 76 different borrowers from you, or 1 rupee each, right? Now, in different countries, there are different rules, but in the US, first $250,000 per depositor is guaranteed by the FDIC. And for that, you pay some FDIC insurance. So you pay some fee to them on your total deposit size, and then you have that. So coming to Silicon Valley Bank specifically, what Silicon Valley Bank did very well was they would quote all the startups once they got their initial funding round, like a Series A. So they would say, you know what, maybe you'll raise your Series B in like a year or 2 years time. We will give you a line of credit. We'll give you a loan for 18 to 24 months at a very cheap rate. So they got like these kind of, they said that you can use for your working capital. There's a credit line, provided you move all your payroll, all your other banking requirements, all your deposits to us, right? So that is one thing. Then what they did is, for the founders and for a lot of the employees, they were very stock rich, right? And they did not have, say, easy cash flow. So they gave them a lot of mortgages at like very good terms, right? Because they knew that these people are eventually, this business is growing, they'll be wealthy. When they actually eventually cash out, they can repay the mortgages very easily. So, and this is very skewed geographically, locally in Silicon Valley. So there's a lot of incentive for startups, etc., to bank with Silicon Valley Bank. And this was like a very high concentration. Then what happened is after 2020 onwards, with the large expansion plans, a lot of funding raised in 2020, 2021. Even if you raised a lot of funding, you did not actually spend all of it. So your deposit base grew a lot. And now the deposits are very concentrated. So it's a rare thing that only 8 billion out of the 190 billion odd deposits, only 8 billion are below the 250K threshold. Rest is all, so they're all jumbo deposits. So when you have jumbo deposits, instead of say you have 80 depositors I mentioned, right, of 1 rupee each, you only have 8 depositors with 10 rupees each. So any one taking out money can be very catastrophic, right? So that's one part where they kind of, everybody has been looking at the asset side of the balance sheet. Everybody said, oh, a large exposure framework. What if I lend a lot to one person and he defaults? But what if the people I borrow, they take their money out soon? So nobody bothered too much on that, right? So that is one thing. Second thing is all the surplus cash they had, and in 2020, 2021, you thought, oh my God, we are going to be in low rates forever. The Federal Reserve is printing so much money. And they had a lot of cash, which they invested in mortgage-backed security. What has happened is, say, US 10-year bond yields has gone from 1 to 4%. Overnight rates have gone from 0 to 4.5. Mortgages, which were available at 2.5 to 3%, and the mortgage-backed security after the cost, etc., you are yielding 1.5% for an amortizing 30-year mortgage or an amortizing 15-year mortgage. So now these rates have gone to 6.5 and 7%. So what happens is my asset is only paying me fixed 1.5% of my principal, and as the principal is being repaid in equal installments over 360 installments over 30 years. And my borrowing now with overnight rates rising, the deposit rates are rising. I am earning 1.5%, but I'm paying 4.5% overnight, or if I borrow in the money markets. And now this is a 3% kind of loss. Still overnight rates, we don't know where interest rates go over the next 30 years. But at this point, it's a cash flow negative thing. In the US as well as in India, because these interest rate movements and bonds yields go up and down, you have an option of whatever securities you buy, you keep it in either a HTM portfolio, which is held to maturity, or an available for sale portfolio, AFS. In HTM, you do accrual accounting, that I buy something and I'm getting, think of it as a fixed deposit, I'm getting accrued interest over a period of time. Whenever it is paid off, that is it. I don't mark to market my principal. And on the AFS book is securities which you're buying and selling and using for your regular liquidity operations. So that is it. So for Silicon Valley Bank in particular, they had a very large AFS section versus an HTM section. So they were the ones which have actually come out and said, oh, we have a problem. But this is actually true about a lot of other regional banks. But maybe their lending was more corporate lending, which is more floating rate. So when interest rates go up, both on your liability side and your asset side, both go up. B, you have a lot of depositors with less than 250K. So then nobody's worried about, oh, this bank will go under and I will, I'm unprotected. There were a lot of people. The 250K dollars is a lot of money. It's 2 crore rupees, right? But yeah, in the US, Silicon Valley is very rich area. So there are a lot of jumbo deposits. So that's another thing, right? And so in this thing, you can say, and lastly, actually all the tech startups, if you look at it, they actually have very high sensitivity to interest rates. Because when interest rates are low, people will go speculative venture lending, etc. When interest rates are high, these valuations come crashing down because the profit you make somewhere far out in the future, you discount all these cash flows at a higher level of interest rates. So that valuation comes down. So maybe the loans that you've given out as well might not be that great, right? And now small tech startups will probably use the line of credit and withdraw cash because they are Series B, Series C, the further rounds might actually be delayed. So they might actually take on all the venture debt. So that is one part which was wrong. And two, given that that all your liability side is very interest rate sensitive, your asset side is also interest rate sensitive on the other way around. So if you look at it, it's a very bad risk management. They actually fired their risk manager. If you look at their previous presentations, I think they were drinking the Kool-Aid and they were quite woke. They were worried more about global warming and equality issues and gender equality. This is from their conference call, their earning call transcript, right? And less about what is the duration of my portfolio, what is the sensitivity, how concentrated is my portfolio, both on my assets, the amount I've lent, and how much on my deposits, right? So I think it was a very badly managed bank. I'm now speaking in my own personal capacity, not for anyone else, and they've kind of paid the price for it. Probably now it's over the weekend. FDIC has said that obviously I think the shareholder value goes to zero. Probably a lot of their other bond borrowings, etc., might have to take a haircut. For depositors, up to 250K obviously is insured. FDIC might say that, on the asset side, all these mortgage-backed securities or government bonds, if you look at it, if you bought them at 121, they're trading at about 80 cents on the dollar. But these are all good. There's no risk of default. Bond prices go up and down based on interest rates, and there's no credit risk here. So maybe you can repo these and get some sort of, you can lend against this. And they said that probably 30 to 50%, they might actually allow people to borrow, take out even above the 250K threshold, right? And they will manage the sale in an organized manner. later on. We might see somebody coming to buy out the bank. And if somebody buys out, they'll get a very nice customer base. You have access to a lot of the West Coast elites, and the brand, the value is out there, right? So, and maybe you say, you know what, I will take it. Maybe on the total asset minus, so your assets minus your debts is actually minus 10%. So of 200 billion roughly, it's about 10%, 20 billion loss, which either the Fed or someone gives them like a cheaper lending line, which they pay over 10 years. This is the value that you say, you know, I've got access to, like not just like people from Silicon Valley, but global startups who are coming in and operating in Silicon Valley. I get a lot of access to those people. And maybe in the future, if I can make business on that, if I can make 2% net interest margin over 10 years, I should be able to make back this, you know, 20% on this, and which I'm paying kind of 10% of the balance sheet on it. So maybe we see that. But that might lead to like greater concentration of big banks, but we'll see. And if this doesn't happen, then actually what will happen is people will withdraw all money from all other regional banks, and anyway you'll see concentration in the big banks. So it's not an easy thing. So if we forget the 2008 crisis, that was like Lehman Brothers had like 70,000 counterparties in OTC derivatives. Silicon Valley Bank doesn't have it, so it's not globally systemically important investment bank, right? So it's not that. It does not have like a lot of OTC contracts. It is not levered 33 to 1 now because of banking regulations. It's more levered 10 to 1. So their equity is for $10 of equity, they have $100 of assets. Lehman was levered 33 to 1. So for $100 of balance sheet, they just have $3 of equity, right? So it's not all that bad. But what is bad is that everywhere in the world, interest rates have risen. I'll give an example. In India, RBI has raised repo rates from 4 to 6.5%. In US, Federal Reserve has raised rates from the corridor 0 to 25 basis points, 0.25, to 4.5 to 475. And we might see peak of 550 or 6%, who knows, this cycle. Maybe after this, we might see fewer rate hikes. The 10-year government bonds in India at the lows during COVID was 5.75%. It has gone to 7.5% or 7.4%. Yeah. So we've seen, okay, fine, 275 basis points of increase. In the US, it has gone from 50 basis points, 0.5%, to about 4%. So 3.5% increase. And as for home loans, mortgages, in India, all home loans are floating rate typically. But we saw rates go from 6.5% to say 9.5% or 9%, right? So again, all of these I'm saying ballpark kind of moves. In the US, the yields have gone from 2% to like 7%. So all of these are big interest rate shocks. I'm just comparing India and the US. Similar story in Europe. Similar story in like Latin America, maybe much bigger. It's much bigger rate of increase. In actually China, no rate increases. Japan, no rate increases. But this is like kind of like large world. And a lot of people in the last 15 years, they've forgotten that, you know, interest rates can move and they can move fast. And they've forgotten how you look at interest rate risk. And all the focus had been on credit risk. That whoever I lend to, will they pay back? But if I'm lending to someone at fixed rates, can the interest rates move so much and my asset liability mismatch that I am investing for 10 years or like 15 years, but I'm borrowing overnight every day. And every day I keep rolling over, and on my average rate of borrowing, so average rate what I'm getting minus average rate of borrowing over these years is my profit, right? And people are running a very large duration mismatch. And so this has come to roost. I think from whatever regulations, the bigger banks in the US, they're all fine. In India, what we have is we have deposit insurance. We don't have that huge concentrated deposits, etc. So that is there. We might see money move from banks to actually debt mutual funds, like money market mutual funds or something of that sort, thinking, oh my God, if I have a lot of money, I'm a rich person, I have a lot of money, instead of a bank, I rather, because the bank could lend out or make wrong decisions. In a mutual fund, whatever the assets are there, they're visible. You can see the NAV, etc. And you can, maybe it's not like a checking account, but I can withdraw money on a 2-day notice. So we might see a lot of these changes. We will see a lot of smaller banks being a lot more vulnerable in the US. It's going to raise a lot of awareness. In the 1990s, it was more concentrated in Texas. Same thing like savings and loans crisis, where interest rates went up very fast, and they are lent out to like development of malls, etc., and they were borrowing short, and rates went up. This is during or just before the oil price spike, Gulf War One. You know, Saddam Hussein invaded Kuwait in those times. And there's a excerpt where Jerome Powell, the current Fed chair, was also handling it as an employee in the Federal Reserve. And there are transcripts out there, there are speeches out there where he said that, you know what, that at such times it is important to kind of backstop all the depositors, otherwise the whole financial system goes away. See, if everybody just says, okay, I'll just invest in US treasuries, etc., there's no credit creation. There's no one who wants to borrow can borrow easily if all the lenders feel that everybody is risky. So all the depositors. So I think they will sort it out. We might see some shotgun merger, and then you might see a lot more smaller banks mergers of it. I think all these banks, as I've said, it's open. We all know how much interest rates have risen. So what kind of mark-to-market losses do they have on their hold-to-maturity portfolios? And maybe interest rates might never go back to zero. So if we, whatever assumptions we had about the economy, inflation, etc., in 2020 to 2021, is a very different world out here, right? So last, I want to say that inflation, which was like below 2% in the US, peaked at 8.5, is about 6.5 now. Yeah. So India actually is very better because India is used to higher interest rates. We had like peak policy rates of 8.5% after the taper tantrum, 2013, 14. We've lived with higher interest rates. We've lived with moving rates. So people are used to, they're not that leveraged. So I think for the US, this is like a very big shock. And Uday Kotak said in a tweet, right, that a sudden shock, like raising rates by about 5% in less than 12 months, you will see the weakest hands fall somewhere. There's going to be some collateral damage. And probably that is the price to pay for running like extremely low interest rate policies for 15 years and printing a lot of money and like a lot of fiscal stimulus that the government did during COVID. And so inflation is there, which is a problem. So higher inflation, so you have to raise your rates too much, and nobody was prepared for it. So, anyways, I've droned on for a long time, but all I'm saying is this will be solved. This had been solved in the 1990s. It feels like a lifetime ago. I was not working or whatever, but the people who are in charge, they have the blueprint, they know what to do. This is not going to be systemically important. We're not going to see a global recession because of this, etc. And maybe the management in one place kind of mismanaged a few things and they'll pay the price for it. But hopefully, this sorts it out soon. There's no panic. And even the FDIC probably will release about 50% of the deposits of it. So if somebody has like a $10 million deposit or a $100 million deposit, maybe 50% they can withdraw immediately, and the rest we'll sort it out. And most probably depositors will be made whole. So you don't want the other moral hazard. The shareholders' equity will get wiped out. Maybe the employees might lose their jobs, etc. The key employees at the top, the ones who are at the operating lower level, will probably be absorbed in another bank when it gets taken over. Yeah, that's it from me.
That's a very comprehensive summary, Nirav. And not to extend this any further, but I just have one question, right? Which is that this interest rate risk that you speak about, right? I'm sure that there are other banks that are susceptible to this as well. So do you see this as a having a sort of a domino effect? With people withdrawing. Their deposits from other banks, and perhaps potentially triggering a bank run of sorts on the other maybe 3 or 4 other banks.
So see, that can happen. See, no bank can survive a bank run. As I said, right? If you have a diversified base, that's how banking works. If everybody chooses to take your money out, no bank will survive. So I think what you need is senior people to come in and create a backstop. Maybe for a short term, increase the amount of money insured to maybe $10 million or something of that sort, right? You have to keep confidence in the system. This is something which is interest rate risk. Like the money which is mark to market loss can come back as well if rates go down. So this is, you have to create confidence. I think they do know how to deal with these things. They've done it in 2008. They've done it in 1990s, right? So 1991, 92, etc. Right? So I think they will come in and do something. I think at a retail level, don't panic, and this will be solved pretty soon.
All right. Well, but in the kind of era that we're living in, I suppose you can't take anything for granted, really. Moving on, Australian Prime Minister Anthony Albanese, who was on a 4-day official visit to India till March 11th, arrived at the Sardar Vallabhai Patel Airport in Ahmedabad on Wednesday. The two leaders, that is Anthony Albanese and Prime Minister Modi, discussed topics ranging from solar power to maritime security and enhancing bilateral security cooperation in the Indo-Pacific region. Prime Minister Modi also raised concerns about vandalism on Hindu temples by pro-Khalistani elements in Australia. Prime Minister Anthony took note of Prime Minister Modi's concerns and said he would take all necessary measures to ensure the protection and security of the Indian community in Australia. Abhishek, this was a pretty interesting meeting, and it seems like the ties are getting stronger. How will this sort of help us counter China in the Indo-Pacific region?
Yeah, I mean, I was just looking at the prime ministers of Australia, and this is the fourth prime minister of Australia during Narendra Modi's time as PM, right? So when he became PM, it was Tony Abbott, then there was Malcolm Turnbull, then there was Scott Morrison, and finally now Anthony Albanese. The only difference is the party has changed. So now there is a Labour government in Australia, right, which is a left of center party. And so it was interesting to see when he came in whether there would be any big shift in the India Australia or say China Australia kind of equations, right? Traditionally, the left of center party in Australia has been sort of somewhat more sympathetic towards China, right? And so there was a question mark of whether, let's say, the Quad initiative, right, which is in some ways a counter to China, whether Australia would continue to be enthusiastic about it and so on. But so far, what we have seen is that there has not been any let's say, major shift in the policy of the Australian government in terms of the Asia Pacific region, right? And yeah, so I think this visit had, several dimensions, right? So there is, of course, the free trade agreement that was signed in December, which is a crucial backdrop to this. With that, there's been a reduction of duties to 0% rate on 96% of Indian exports to Australia and about 85% of Australian exports to India. So that's quite significant, right? There is, of course, on March 2nd, we had a agreement signed between the two countries, which basically recognizes the educational degrees of both countries at each other. So we know that Australia is obviously a very attractive destination for Indian students, right? Right now there are more than a lakh Indian students pursuing higher education in Australia. So that is also a sort of benefit for Indian students in general, right? That they can be kind of assured that Indian degrees will be sort of recognized in Australia. There are a couple of Australian universities planning to open campuses in India as part of the overall sort of idea, right, that India will now welcome foreign universities. There was also defense related discussions. Anthony Albanese actually visited the INS Vikrant, right? And there is Australia is going to hold the next Malabar exercises in August off the coast of Perth. So India, Japan, US, and Australia will continue to participate closely in that. So yeah, I think a lot of interesting discussions on the China topic. Obviously, you cannot expect too much to be said in the open by Australia right now, right? But over the last few years, at least the previous government in Australia was quite strong on China, right? They had banned Huawei from their 5G networks. They had called upon, inquiries into the origin of COVID in China, and this government has kind of not really gone back on any of this. I would say this was quite a important visit, and while a lot of the Australian press and especially the cricket journalists were not very amused by the two prime ministers sort of doing a mini parade on the first day of the test match, right? I think it got pretty stinging
They're still
criticism
talking about
in
it.
the Australian press. Yeah, they're still talking about it. I saw a picture of them, all their journalists also jumping onto the that sort of whatever Batmobile that was prepared, and trying to make a mockery of it. So it was interesting, but I think like with most Western countries, the relationship between governments is often more mature and better than what is portrayed in their media.
In more geopolitical ties, India and the US on Friday inked an initial pact on increasing private sector cooperation in the area of semiconductors to reduce their dependency on China and Taiwan. The MOU was signed by US Secretary of Commerce Gina Raimondo and Commerce and Industry Minister Piyush Goyal during the commercial dialogue here. Both sides have agreed to set up a semiconductor subcommittee led by the Department of Commerce for the US side and the Ministry of Electronics and Information Technology, that is METI, and Ministry of Commerce and Industry on the Indian side of things. Nirav, we're finally seeing a semiconductor deal struck between the India and the US, and it's not just with private institutions. How will this be significant? How will it benefit the private players and so on?
Yeah, so if you look at it, one thing is that the whole semiconductor business, right? The Silicon Valley, earlier Silicon was all the semiconductor companies were set up in the 60s, right? When that was in the US space race, etc. And you had all the Intels, the AMDs, and that's how we got that. And then what happened is all this like labor intensive manufacturing, and then which later on became capital intensive manufacturing, was all slowly, it went to Japan, it went to Korea, then Taiwan, and the lower end went to China, right? And all of the semiconductor business was like controlled totally and by China and Taiwan. So TSMC is a leading one for the cutting edge chips, which are 3 to 5 nanometer and 7 nanometer chips. Korea has a bigger advantage, Samsung and other Korean companies, on the memory chips. And a lot of the old legacy, which are like the 65 to 75 nanometer or 100 nanometer chips, are all made in China, right? This is very concentrated. And we saw during COVID, there was like a big supply chain shock. A lot of car companies couldn't make their cars because of like the shortage of chips, etc., right? And not just like in mobile phones or laptops, computers, electronic equipment, right? Like these small electronics go in everywhere. The LED display on your fridge, So everybody wants to have more resilience and not to have too much dependence on China. Taiwan, there is like the worry about any geopolitical escalation, like between Russia and Ukraine, and we don't want that shock. India has this whole PLI schemes, and they've tried to raise money. They've said that okay, if you produce semiconductors here, we will pay you. A lot of work has been done on electronics assembly so far. So India has done quite well over there. There is one MOU signed between the Vedanta Group plus Foxconn. Foxconn is a traditional assembly person in the electronic space, but not so much in like semiconductors. And they're trying to find a JV venture with like somebody who has a technology component so that they can make chips in India, right? And India has done something there. US has two things. One is the Inflation Reduction Act, which is trying to win back manufacturing back home from China. And it's not just in electronics or semiconductors. In every industry, China has like taken over major world manufacturing share, right? And a lot of jobs, etc., has gone there. So that is one thing. They also have the specific to electronics, the CHIPS Act, and they've given incentives for TSMC to set up chips plants in Arizona. And then Apple is saying that all the phones which would be sold in the US, they will want to have chip sourced from the US, right? That's also for security reasons. So you had cases before where Chinese companies like Huawei and ZTE were either seen to be spying, or there were a lot of security issues, right, on those ones. That's the case that both these countries want to get a better part of the resilient supply chain and want to have a foot in that electronics and semiconductors game. So now here, US is also, apart from doing reshoring, is trying to do friend shoring. That they say, okay, we are going back to the old Cold War, and they say who are friendlier nations with us, and try and like get the supply chains rerouted from the ones who they don't trust versus the ones that they trust, right? And so with China, there's a lot of mistrust. So they want India to succeed here because all the things which can be done in China can't be done in the US. So India has a large pool of labor, right? Which is kind of used unproductively in agriculture, where or like people are taking NREGA doles, etc. And if this could be upskilled a bit and then put into manufacturing, a lot of the lower end manufacturing, assembly, etc., can be done in India. Maybe the cutting edge, which is very capital intensive part of with like advanced lithography machines, etc., can be done in the US. So like India and US are kind of complementary. We've seen that in software services, right? We've seen that even in chip design. So what does India have? India has a lot of labor, but capital is expensive. US has a lot of capital, but labor is expensive, and more so with all this like higher cost of inflation and the shortage of labor, as well as the demographics are flipping over. Right, a lot of baby boomers are retiring, etc. So I think this is a case you see some complementary ties, and I think see semiconductors is like a very key thing with a lot of geopolitics and security, right? So geo-economic focus is on semiconductors, but hopefully this kind of builds like a bridge which can actually extend to like other manufactured goods, etc., as well. And here it's like the US wants India to succeed. Right now we are 1/5 the size of China. Probably if we ever do reach the size of China, if we expand our economy 5x, then maybe the things will turn. But for now, US is happy if you go from like a 3.5 trillion economy to like a 5, 6, 7 trillion economy, right? China is an 18 trillion economy and US is 25. So there they consider themselves as rivals. So I think that's a good thing. It's like good partnership. We've done very well on like the software side, and it's time that we replicate that on the hardware side, right? And we will also further see cooperation. And they mentioned this in renewable energy, in smart grids, in like the hydrogen, green hydrogen technology, etc. Right? Energy storage, batteries. So all of these areas are like focus areas. But I would say if you were to pick up one, I think semiconductors has key geo-economic focus, and so that is why there's some cooperation, and it's a positive sign. But you've seen like the US has flip-flopped. Indians also sometimes in negotiation we stick quite hard on certain aspects where we want to protect certain parts of our industries. Some of it may be optimal, some of it may be constrained by local politics, etc. as well, right? So it's a good positive step, but like let's not be too optimistic. Let's be realistic and see how it goes on step by step, because even the US is bothered about security of its own technology, and they may not have do that much technology transfer. Like we might be friends or allies, but we are not close friends as, or we are not like a US vassal state which would obey everything what the US does, right? So they do treat us a little bit with suspicion as well, and they have another key ally in the region, which is Pakistan, which they don't want them to flip over to China, and then there'll be some pressure from Pakistan as well if they are seen siding with India too much. So there are all these like, kind of constraints, but all in all, it's a positive step, and hopefully one of like many more to come.
Yeah, there were some interesting memes showing, Dr. Jaishankar and Mr. Raimondo celebrating Holi on one panel, and then, this semiconductor deal being announced on the next, right? Pretty interesting stuff. Well, seems like geopolitics is the flavor of the weekly this week. China has brokered a peace deal between Saudi Arabia and Iran, two countries that have long had disagreements and had severed diplomatic ties. This deal includes a possible path to rein in Tehran's nuclear program and a chance to cement a ceasefire in Yemen. The deal was announced after 4 days of previously undisclosed talks in Beijing between the Middle Eastern rivals. The US, which has been the central actor in the Middle East for long, has been taken by surprise and now find themselves on the sidelines during a moment of significant change. Analysts say that this deal is a broader sign of a changing global order. Abhishek, what does this mean for the US? I mean, it feels like they've been totally blindsided by what has happened. Do you think that this will be the death of the petrodollar and perhaps the rise of the petro yuan?
Yeah, so it's obviously too early for making such kind of predictions, but I think the big important point here was the complete surprise to global media everywhere, right? Like no one had any inkling of this before this deal or whatever you can call it was announced, right? And so, just to step back a bit, in 2016, Iran and Saudi Arabia basically severed their diplomatic ties because, as part of 47 terrorists being sort of executed by Saudi Arabia at that time, it included a very revered Shia cleric, right? And Iran is, of course, you could say, the fountainhead of Shia Islam, right? And so that sparked an outrage in the region, and that's when Iran basically cut off ties, diplomatic ties with Saudi Arabia. So since then, the two countries have been having some sort of back channel discussions in Iraq, right, with Baghdad being the primary party trying to bring these two together. Of course, Saudi Arabia is supposed to be a big sort of US ally, and Iran, right, is obviously like a big sort of axis of evil country, right, for the US, with their nuclear program being, a big sort of political hot topic even in the US, right? The Obama administration was trying to sort of have a deal with Iran in terms of disclosures, etc., which then Trump reversed, and all that is in the background. Now, another interesting development that has happened over the years is basically that liberals in the United States have been sort of making a lot of noise about democracy and being anti-authoritarians, etc. And in some ways, Prince Salman of Saudi Arabia has also had some sort of blowback on that, right? There was this whole case about the killing of the Washington Post journalist Khashoggi in between. But in general, I suppose you could say that the Saudis have been sort of feeling a lot less love from the United States than they are, generally used to. And so I would say that probably the Chinese took advantage of this, right, emerging situation, and were able to pull off this sort of big diplomatic coup in a sense to bring both Iran and Saudi Arabia to the table and trying to sort of normalize the relations. So now the expectation from the Saudis would be that they get a bit of relief in terms of the situation in Yemen, right? Whether Iran backed Houthi rebels are sort of reined in by Iran over time. While for Iran, they have been sort of facing a bit of the Western fire in terms of their own domestic protests, right? And there is a Saudi Arabia run satellite channel called Iran International, which kind of gives support to the protesters, right? And so the Iranians probably will think that the Saudis will sort of back out a bit from there. But in general, one of the countries that has sort of expressed their sort of disapproval on this is Israel, right? Because they are always worried about the Iranian nuclear threat. What the Saudi side has been saying about the Iranian nuclear threat is that they do not expect to put any more new requirements over and above what the United States or the Western community, I mean, I would say the global community has been trying to put on the Iranian civil nuclear program or whatever, right? So, yeah, I think overall it's a fairly sort of new and interesting development, which kind of shows sort of slipping of the US influence in general, right? Where countries are no longer looking only at the United States as their sort of primary focus. And I would say it's a big sort of win for China in terms of increasing their influence
Yeah,
globally.
I think post the shoddy withdrawal of the US from the Afghanistan, I think this is perhaps the second most significant development, I would say, on the geopolitical front that kind of signifies, if not a waning, at least a lessening influence of the US in geopolitics, right? Yeah, pretty interesting times. All right, so that's a wrap from us here on the weekly. If you stayed on up until now, I mean, if you like the content, don't forget to rate and review us on your favorite platforms. It'll really help more people discover all of this awesome content that we're producing. But otherwise, from Abhishek, Nirav, and myself, thank you so much for joining us this week. We'll see you next week. Until then, stay safe, take care, and Jai Hind.